Good morning, everyone, and welcome to Hein and Associates Top Tax Issues to Consider for Technology Companies webinar. I'm Jennifer Nichols, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted, so please use our chat feature to ask questions. We will save time at the end for Q&A. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course, a link to the webinar recording, and presentation materials. Our presenters today are John Monahan, CPA partner of the Denver office. John joined Hein and Associates as a partner in 2016. With over 25 years of experience, he specializes in providing advice to corporate taxpayers. In particular, John advises companies on tax compliance and income tax reporting matters, which include tax filing positions, complex transactions, ASC 740 reporting requirements, and Sarbanes-Oxley 404 requirements. John is a graduate of the University of Colorado Boulder with a Bachelor of Science degree in accounting. He went on to receive a Master of Taxation degree from Bentley University and a Master of Business Administration from the University of Colorado, Denver. John strives to use his years of experience and honed skill to add value and exceed client expectations. We also have Matt Mueller, CPA tax manager in the Denver office. Matt has almost 10 years of public accounting experience and serves as a tax manager in the Denver office of Hein. He specializes in manufacturing and distribution tax compliance, including domestic production incentives and credits, accounting method changes, tangible asset regulations, and transactional work, including asset sales, liquidations, bankruptcies, and reorganizations. Matt received his Bachelor of Science in Accounting and Master of Science in Accounting from Marquette University. Matt is a member of the American Institute of Certified Public Accountants and the Colorado Society of Public Accountants. In addition, Matt is on the membership committee of the Colorado Advanced Manufacturing Alliance and a Colorado Brewers Guild Allied Trade member. Our first polling question today: what type of entity is your company? LLC, S Corporation, C Corporation, partnership, or other? Thank you for attending today, and I would like to now introduce John Monahan.
Thank you, Jennifer. And I can see from the polling results that a large majority are people from partnerships with a large representation from C corporations as well. So I'd like to jump in and start. We're going to first talk about business formation and choice of entity. There's pros and cons depending on which entity you choose. First of all, I'd like to talk about C corporations, and one of the major advantages of C corporations are the legal risk is contained within the entity, and so it doesn't reach to the owners of the business, and you can also say that's true of an S corporation or an LLC. Partnerships, on the other hand, are the legal liability can reach the owners of the business unless you're a limited partner. One of the major disadvantages of a C corporation is how it's taxed. It's basically subject to double taxation, and by that I mean it's taxes incurred at the entity level for its operations, and then tax is also incurred at the individual level once distributions are made out to the owners of the business, where it's taxed as a dividend or possibly a capital gain. Only if it was a return of capital would it not be taxed to the individual owners of the C corporation. The S corporation, on the other hand, is a flow-through entity. It's not taxed at the entity level. In fact, the income is reported at the entity level, but then also reported on a investor's K-1, which is information reporting to put on their individual tax return, where it is taxed at the individual level only. S corporation allocates income pro rata based on ownership of shares. That's not very flexible in an S corporation. It has to be pro rata. There's also some restrictions that have to do with who can own an S corporation. And basically, the owners are limited to domestic individuals or a trust where a domestic individual is the beneficiary. Can't be corporations, other partnerships, can't be a foreign individual. And also, it has to be less than 100 shareholders for it to qualify as an S corporation. If you have an owner who's disqualified, then you basically dissolve the S corporation and changed it to a C corporation. LLCs, on the other hand, are very flexible. They also offer the benefit of limited liability. What they do is, or how they're taxed, is they default to a partnership level of taxation unless you choose otherwise. So to understand how income is allocated at the LLC, much like a partnership, you would have to go to the LLC operating agreement, where the intent of who gets allocated income and loss is spelled out, and that's how it's done. One of the drawbacks of an LLC are that payments to the owners are basically considered guaranteed payments. They're not salaries. They are deductible, but the problem with guaranteed payments are they're subject to SE tax, self-employment tax at the individual level. Okay, next slide. Partnerships are an entity that's very flexible both to set up and to dissolve. A partnership can be formed formally or informally. Basically, all you need are two or more persons engaged in a business enterprise for profit. You don't actually have to have a partnership agreement, although it is advisable that you have one to clear up any future misunderstandings and to spell out exactly who's allocated what. So a partnership's very flexible, very simple, and it's different from an LLC in that you don't have, as I mentioned earlier, the liability protection to the owners, especially the managers of the business who would be general partners. Limited partners can get liability protection, but they're very passive investors and they don't manage the business at all. Formation and conversion, basically you can form a corporation and a partnership by contributing property or cash, and generally that can be done tax-free. For a corporation, you must basically take back at least 80% of the voting control of the stock for that to be a tax-free transaction. You can do it one person, or you can do it with a group of people called a control group for it to qualify. And it usually in a corporate setting, it has to be done all at once. So contributing property and cash, taking back at least 80% voting control of the stock will qualify as a tax-free transaction. Partnerships also, under their specific code section, can have tax-free contributions to form the business, and it's not as restrictive. It doesn't need a control group. The contributions can occur in phases with different partners. Okay, so owners would be the contributors of the property. Also, owners can be contributors of services, and when that occurs, the contributor of the service will have to recognize ordinary income in the form of compensation. Special considerations for corporations and LLCs. Well, LLCs have this distinct advantage where they can change their type of entity through an entity classification election, or what's known as check-the-box election. So like I said before, although it defaults to a partnership tax treatment, an LLC can elect to be treated as a corporate entity and taxed as a corporate entity by following this entity classification election, which is a very simple procedure to do. And so LLCs have that flexibility. Also, if an LLC is a one-owner LLC, single-owner LLC, it's basically treated as a disregarded entity. So what that means in practice is if it's owned by a corporation, it's taxed as a branch of that corporation, included in that corporation. If it's owned by an individual, it's basically treated as a sole proprietorship and reported on the individual's tax return. Next slide. One major benefit that's come up with the recent PATH Act that was enacted at the end of 2015, and it really only pertains to C corporations, but I want to mention it because it is a really good benefit, and it's called the Qualified Small Business Stock. And what that is, it's a beneficial treatment when the shareholder sells their stock, basically excludes 100% of the gain if it's sold after September 28th, 2010. There was partial exclusion in earlier years depending on when you purchased the stock, but if you purchased after this September 28th date and you sell it, provided you meet these requirements that I'm going to go over here, if you sell it, you can exclude 100% of the gain on that stock. Now, there are some pretty restrictive requirements here that you have to meet. One is you have to hold the stock for at least 5 years. You also have to, it has to be original issue stock. You can't buy it from another person. It has to be on formation. And there cannot be any significant redemptions during the holding period of this stock. Now, you can acquire the stock through, a restricted stock program, stock option program, or debt that's converted into stock, and that qualifies as original issuance. But that 5-year holding period starts when you actually hold the stock, not when you have these other types of investment vehicles. Other restrictions that you have, it must be a C corporation at the time of sale, and it must be a C corporation for substantially most of the time the stock is held. Also, this is really designed to apply to small businesses, so you must not have more than $50 million in assets at the time the stock is issued or shortly thereafter. And for substantially all the time that you hold the stock, at least 80% of the value of the corporation must be in the active conduct of a trade or business. And lastly, the gain is limited. It's a very high bar. It's the higher of 10 times the cost of that stock to you or your basis, or $10 million, and I think most people, the limitation would be $10 million, which is a very high number. So I think a lot of, especially emerging technology companies, could use this benefit and should be on the lookout to take advantage of it. Next, I'm going to talk about common financing vehicles, equity vehicles, and how that's treated for tax purpose, what I see with technology companies typically. Typically what I see are multiple rounds of preferred stock equity and also debt financing, a lot of times in a convertible form. So preferred stock, it operates a lot just like common stock. I mean, you don't pay tax on it until you get cash or property is taxed as a dividend, much like common stock. Also, like common stock, it gets a preferred rate depending on your income level. Usually in preferred stock, you don't get fluctuations in value, so the tax implication is usually on the actual distribution of dividends. And with preferred stock, like common stock, you can participate in a tax-free reorganization. So even though preferred stock has a look and feel of debt in a way that you get periodic payments, the tax treatment is more like common stock. Now, debt is a little more complicated area, not as straightforward. The key to debt is it needs to be bona fide debt, and even though it's shown on your books and records and your balance sheet as debt, you really, for tax purposes, need to have that documented. It needs to be a bona fide debt. It needs to be an unconditional promise to pay. That's the key, and it needs to have terms like you'd see with outside debt, with payment terms, interest terms, repayment terms, and so it really should mirror what outside party debt would provide, and also the interest rate needs to be within reason when compared to outside party debt. There are limitations on interest. There are The two that I come to mind are related party interest or related party debt. Basically, that makes you match the deduction with the income to the related party. So you can't take that interest deduction if you accrue interest and the recipient or the person that's going to get the interest does not recognize it as income. So that you need to be careful about. Also, there's these what's called thinly capitalized interest rules where the majority of your equity and debt structure leans towards debt, and that the ratio is heavily leaning towards debt. So the IRS has come back and said, well, that's really a part of that. It needs to be equity. It really resembles equity. So there are rules in place to limit the yearly deduction of interest if you qualify. So they'll apply this debt to equity ratio, and if you're over that, then these rules kick in. And so there's a calculation. It's very mechanical, depends on the activity of your business, but has the effect of possibly limiting your interest deduction. So be cognizant of that. And lastly, cancellation of debt income does occur with especially small businesses. It happens sometimes in periods different than when you took out the debt, incurred the expenses, and deducted those expenses. So it has the appearance of phantom income sometimes. But really what it represents is just a reversal of those prior expenses that you've taken that you really and truly didn't pay for since you canceled the debt that it was based on. So I see that often, and because it occurs in different time periods, it can lead to some issues where you have this phantom income and don't necessarily have the cash to pay the tax on it. So that's an issue with technology companies that I see often. Okay.
Okay, our next polling question. Do you have customers in other states where your employees travel to perform services? Yes or no?
Okay, we'll give you a few minutes here. Okay, a large percentage of the people responding say yes, and that leads right into my next discussion point, which is state and local tax considerations. So primarily what I want to talk about are nexus issues. Nexus is simply you've reached a certain threshold where the state is going to require you to file a tax return and possibly pay tax. There are different nexuses or thresholds for different types of tax. The three that most commonly I see are sales tax, income tax, and franchise tax. Sales tax and franchise tax have a much lower threshold for creating nexus, and basically they're kind of on a minimum contact threshold. So it doesn't take a lot to create nexus for those two types of tax. Income tax, on the other hand, can be a higher bar, and especially if you're selling personal tangible property, they have this thing called Public Law 86272, which can protect you if you've only got salespeople moving in and out of the state, basically soliciting orders for sales. They're not approving orders, they're just soliciting. So even though you have a person in the state, having activity in the state, there's a possibility that you haven't really reached nexus or have a filing requirement in that state. Now, there are unprotected activities that will basically pierce that 86272 protection, and a lot of them I see in the technology arena. For example, if you've got orders that are approved or are approved and shipped within the state, then you basically have done an unprotected activity and created a nexus. Other types or examples of things that might create nexus are providing maintenance or services for property sold within the state, or if you're installing or supervising an installation of some type of product to a customer in another state, that can pierce the public law protection. And conducting on-site training with your products in that state can also be a problem area and can create nexus. So the next thing I'd like to talk about are some new rules that some states are putting in place. First, there was California that did economic presence nexus. So even though you might not have a person in the state or even have any people actively doing things in the state, soliciting sales or anything like that, they might say you have economic presence. And what that is is you reach a certain threshold within certain factors, and really it's really your apportionment factors. It's sales, it's property, and it's payroll. For example, if you're over 500,000 of sales, California sales, you have surpassed this economic presence nexus threshold, and they will require you to file in California. Their thresholds around payroll, I think, are 50,000, and property the same. So if you reach those thresholds, you might have a filing requirement. And I will say more states are adopting this methodology. I think we're up to 4 or 5 states beyond California, so be on the lookout for that. Service companies, on the other hand, have a different way of allocating income to their states. And basically the two that I see are cost of performance and market sourcing. Cost of performance allocates revenue to the state you're actually performing activities in. So Colorado is considered a cost of performance state. And if, say 80% of the activity is being conducted in Colorado, then that revenue would be apportioned 80% to Colorado. A large majority of the states practice market sourcing, where that's really where the customer resides. So California is an example of market sourcing. So if you've got people in California, that allocation of income will go mostly to California. You've got customers in California. So you can, like I said, trip nexus at various stages as a company grows and expands, and might not even be aware that they're doing that. But there are remedies for this situation. All states that I know of have a voluntary disclosure agreement criteria where you can come forward and basically come clean on liabilities that you've established. And the advantage of it is that you can close the look-back period, and also you can get certain penalties eliminated usually. So if you find out that you have nexus in a state and should have been filing, really consider doing voluntary disclosure agreements to limit your liability and limit your statute of limitations. So filing requirements for pass-through entities. There are some burdensome things here, especially with non-resident partners. Partnership in many cases can create a filing requirement for its individual owners or its owners in general. And so a partnership or a non-resident of a partnership can end up filing in many states. And so what happens a lot of times is that the partnership will file on behalf of the individual owners and pay the tax on behalf of the individual owners. And that really alleviates some of the administrative burden of the individuals having to file a lot of different state tax returns. Non-resident withholding is also an issue for these non-resident partners. Many states require withholding on cash distributions, especially to the individual level. So even though not filing in a state, you might have some withholding taken from any future distribution for a non-resident partner. Okay, sales tax. I do want to talk about this a little bit with software sales because it is a very contentious issue. Basically, it's contentious because a lot of states have not kept up with technology that has evolved over time. And so they're trying to apply old rules to new technology and new ways of doing business. So software sales are getting caught up in this kind of web of taxation because the states or the localities are being very aggressive about that. So even though you're not in the state, you're not headquartered in the state, you don't have a location in the state, if you've got users in the state, a lot of times that will trip up a sales tax liability. Or if you've got a server in the state, also that will be considered to create nexus in a software or a sales tax liability. Okay, I'd like to move on to the polling question.
Our third polling question, if you have foreign customers, in what country or countries are they located?
Okay. Looks like the most common answers are?
We've got quite a few here. We've got Canada, United Kingdom, Australia, Austria, Guatemala, Philippines, UK, Singapore, there's quite a few. Mexico, Netherlands, England, Japan.
Right. That's what I see. In practice, if a company is going to start to go into foreign countries, I see Canada and UK quite often. I think just the ease of doing business in those two countries. So there are some international tax issues that you need to be aware of as you expand your footprint globally. Basically, just as a background, the U.S. uses a worldwide system of taxation, and really what that means is it taxes income everywhere in the world. It will give you a deferral possibility for, say, if you have a subsidiary in a foreign country. So they won't tax income in those foreign subsidiaries until you actually repatriate cash back to the U.S., and then at that point, they will. There are withholding tax issues around payments back and forth between countries and to the U.S. On dividend income especially, there are withholding tax requirements, and it depends on the tax treaty in place with the different countries. Also, generally just sales transactions, royalty transactions, interest transactions can have withholding tax on them. And again, it just depends on how the treaty spells that out for the different countries. Entity classification can be very important, especially in the initial setup of a business. In many cases, you're going into new jurisdictions and you're incurring losses, so it would be ideal if you were in a flow-through situation where the losses are flowing up to the U.S. parent and able to net against income. Also, in order to avoid this repatriation issue when it goes to the U.S., a lot of companies set up holding companies, and they're able to basically move cash between foreign jurisdictions. So they repatriate money up to the holding company and then back down to another country without having to filter it through the U.S., and that prevents any U.S. taxation and keeps that deferral of foreign earnings still in place. Check-the-box planning, often used in international structures as well, enabling basically to treat single-member LLCs as branches able to net the losses with income of different entities, and so can be a very effective planning tool. IP ownership and location. Used to be far more effective than it is today because it was very easy to transfer IP tax-free, but with new regulations that have come out, it's basically create a taxable event when the IP is transferred out of the U.S., but it can still be valuable if the value is low of the IP when it is transferred. And what that does is the value goes offshore in the form of IP, and the U.S. jurisdiction, which is generally the highest taxing jurisdiction with the highest rate, will pay a royalty for the use of the IP and therefore able to lower its U.S. income. So that's the value there, where the income would be recognized in a lower tax rate foreign jurisdiction. Often seen in the past, but the government has come up with new rules that have made that less easy to do. Intercompany activity and transfer pricing, that's very common issue that I see when companies are forming new companies abroad. Basically, there's this concept of risk out there, and in a nutshell, if you maintain all the risk at the U.S. and none at the foreign locations, basically a distribution company, then really they would say that you should have some level of income in these foreign companies. So that's the concept they look at. They look at arm's length standard and comparables with similar companies in your industry to see what a third party would pay in a specific set of transaction facts like you would have with your company. Intercompany debt, another huge issue. If debt is pushed down to the foreign entity really needs to treat it as debt and again have it documented. The U.S. company would need to accrue interest on that. If it's going the other direction and the foreign country or company is loaning the U.S. money, that basically creates a deemed dividend situation. and can create considered income to the US in the U.S. jurisdiction. So common exposures that I see for startup technology companies, basically it's around just their expanding footprint, at least initially. First of all, they're going into countries that they're not realizing they're creating what's called a permanent establishment, which I'll talk about here in a minute. And so they don't realize they have a foreign filing requirement and possibly a foreign tax liability. The other part is they don't have their transfer pricing in place, so they haven't determined that they really should have income in these foreign jurisdictions, especially if there's no risk involved. And that can also create a foreign tax exposure. So my last slide here on the international tax issues, I want to talk about foreign tax credits. They are available to companies because they pay tax in a foreign jurisdiction but also pay in the U.S. when they bring back cash. The U.S. does allow a foreign tax credit. It's a specific formula to determine how much you can use, and it depends on if you're in a high tax or a low tax foreign jurisdiction. So very complicated to figure out, but it's designed to mitigate double taxation of foreign source income. And the U.S. and non-U.S. filing requirements, of course, you've got the foreign filing requirements in the respective countries that you need to get your hands around if you create a permanent establishment. And a permanent establishment, by the way, is a lot like Nexus, but when it is created is when you have a fixed place of business in a foreign country or you operate with a dependent agent that has the authority to conclude contracts on behalf of the corporation. Those are the two fact patterns that will, in most cases, create a permanent establishment and a foreign filing requirement. So there's your foreign tax returns that you'll need to file, but there's also a lot of U.S. information reporting when you have foreign activities. And they're very heavily scrutinized now, and they're very heavily penalized if you don't abide by them. So what we see mostly are information reporting around subsidiaries, around partnership investments, foreign transactions with, say, a foreign parent or a foreign brother-sister corporation, and foreign bank account reporting. All of that is reported on an annual basis with your U.S. return and the foreign bank account reporting reported at a different time during the year. And like I said, some very significant penalties if you don't comply with these information reporting requirements. So with that, I'm going to turn over the discussion to talk about compensation issues with Matt Mueller.
Well, thanks, John. Now that you've handled all the complicated issues, I'm going to talk a little bit more of some of the more basic issues that we see with a lot of startup companies and some considerations when it comes to exiting a business. So the first thing I want to talk about is the general compensation issues, and we're going to start off with the employee versus independent contractor issue. And this issue stems around the whole fact of whether or not you're paying someone as an employee or as an independent contractor. And the key there is the presence of an employment relationship. So whether a person is an employee or independent contractor will have significant consequences when it comes to payroll tax considerations and whether the worker is entitled to certain employee benefits, including health insurance, and may be able to be a participant in a qualified retirement plan. So a key driver in what determines compensation will be looking at, or whether a person is an employee or independent contractor, will be how are they compensated? Is it project-based, or is it by the hour, day, week, or some function of time? And generally, if it's a function of time, you're going to have that mirrors more of an employee-employer relationship, where if it's project-based, which we see with many technology companies because a lot of the work is on a project-by-project basis, and it's just more efficient to have an independent contractor relationship. But it's really crucial that you pay particular attention to how that relationship is structured so that you're not acting, so that the relationship doesn't smell like an employee-employer relationship. So if the IRS comes in and they're looking at your wages, if they start poking around, what are they looking at to see whether you have an employee-employer relationship or whether the person's an independent contractor? Well, there's two key factors. The first is the behavioral relationship and who has control of the work is done. Does the employer control when you're there, how the work is performed, what tasks need to get done over what period of time? And the second factor that the IRS will look at is the financial relationship. So generally, how is the payment for the services conducted? Is it as we mentioned before, or as I mentioned before, is it for the particular project, or is it a function of time where a person's paid on a weekly or biweekly basis? Another important criteria to mention here is also who really pays for things like job training expenses or tools, supplies, and certain equipment. If the employer or the company is paying for these types of things, chances are you have an employee relationship. Whereas if the individual performing the work is paying for these, good chances are you're okay treating that person as an independent contractor. The next item we're going to talk about, or I'm going to talk about, is incentive compensation. And what I'm getting at here is with a lot of new startup technology companies, the cash in the business, you want to spend more cash towards the business itself, putting more items in there, but you also want to retain some key employees or officers. So in a way to do that and try to think of ways to structure in your business in order to keep employees when you can't really afford them to pay as much. What we see with a lot of technology companies is more intrinsic or non-monetary types of compensation. And what you mean there is maybe a more liberal PTO policy, a flexible work schedule, or being able to work remotely, telecommuting, having like a keg of beer in the company kitchen or snacks and things of that nature to try to make people feel a little bit more comfortable at home, to try to entice those types of people that would gravitate towards that kind of culture and environment. And then on the other hand, there's equity compensation or more financial compensation. There's many different ways that this can be accomplished, and it's nice for new startup companies because the cash burden is not as intense in the beginning of stages of a developmental company. There's stock-based compensation, which includes items like options, grants, and restricted stock. And I'm not going to go into a lot of the details, but the tax treatment of several of these are different. I'm sure many of you know what an option is, a right to buy stock at a future time at a certain price. And traditionally, a lot of the stock grants or restricted stock units that are granted to someone are usually traditionally subject to certain vesting time frames in order to try to keep those employees over a certain period. And what's important to mention here is, in addition to the corporate structure with options and restricted stock, you can also accomplish the same objective with pass-through interest ownership as a form of equity compensation, in order to allow someone to try to grow within the company and be incentivized to make the company prosper. And traditionally, that's done through a profits interest in the company, or in order to get where if the company has profit, it'll increase their capital account or potential ownership and money received on exit of the company. The last item here when it comes to equity compensation is the Section 83B election. This is important to consider for startup companies because traditionally the fair market value of a company on inception is hopefully more than what it is on exit. So when someone receives an equity ownership interest in a company as a form of compensation, it's generally beneficial to pay tax on it, or can be beneficial to pay tax on it on the grant date as opposed to when that equity is vested. And that's just because the fair market value at the time of the grant is generally lower than the time that equity is invested. But it's crucial and imperative to consider that if you're going to, for the employee and the company, that they alert their employees that they're granting some sort of equity, that this election needs to be undertaken within a 30-day period from the grant date. The next item we want to mention here is some of the tax credits and incentives that we run into at technology companies. The largest incentive out there right now, which is now a permanent tax benefit, which was traditionally part of extenders bills over the past, but now it's nice that it's a permanent item, so it can be considered as part of a company's tax planning, but is the research and development credit, or the formal name of the incremental research credit. Like any other tax credit, it's a dollar-for-dollar reduction in the tax liability, and it's based on qualified research expenses. So what kinds of research would qualify for the research and development credit? Well, the research must be performed in the U.S. and can't be performed by a contractor or can't be research conducted overseas. And what types of research activities does this apply to? Well, qualified research is research that is undertaken with a certain degree of science and using the scientific method to discover something that's unknown. I like to think of it, especially for a technology company, as developmental stage expenses, and especially during a beta stage and formation stage of a company until there's that proof of concept or until the product is ready to be sold. During that whole developmental stage, a lot of those expenses, so wages, supplies, and contract expenses like engineering, things like that, would qualify for this credit. And it's a nice credit because it's a dollar for dollar reduction in tax on top of the expenses that you've already paid. The next credit that is not as common, but it's out there, so we're going to make a note of it here, is the investment credit. And it's part of the general business credit, so it carries forward, or you can carry it back 1 year if you don't have taxable income in the current period, and it carries forward 20 years. But the energy credit is part of solar equipment that's used to either illuminate, provide lighting for the interior structure of a building, or to heat or cool a building. And the credit there is provided that the equipment is eligible for the credit, it's 30% of those expenditures. The last item is the Colorado Enterprise Zone credits. And what we find with a lot of new technology companies, or any company for that matter, is that this is not a highly utilized credit. And I'm not sure what the reason is, but it's really easy to see if you are in a Colorado Enterprise Zone, and these are income tax credits. And all you have to do is go to the Office of Economic Development website, and you can simply type in the address of your company or your various locations to see if you are in an enterprise zone. It's important here that, and I really want to mention this, that in October of 2015, the enterprise zones in Colorado were redrawn. So many companies that were in an enterprise zone in 2015 may no longer be in a 2016 enterprise zone just due to certain criteria that the state uses or the Office of Economic Development uses to determine what particular geographic areas are in a zone. However, if you were in an enterprise zone in 2015 and you realize, oh, I'm not in an enterprise zone in 2016 and moving forward, there's an extended application process that can be undertaken in order to get grandfathered into the credits for up to 10 years going forward after 2016. Which can be quite a substantial tax savings on your Colorado income tax liabilities. Going through the three types of credits that we see most commonly, there's the investment credit, which is 3% of your tangible personal property CapEx, and that's your furniture, your computer equipment, or your software. There's also the job training credit, which is 12% of your job training expenses that you pay to get your new employees trained up. And there's also a research and development function, which is calculated a little bit differently than the federal credit, but the definitions and the terms of determining what is a qualified research expense are the same. So there's not a lot of additional work that needs to be performed to take the Colorado R&D credit.
Okay, our next polling question. Approximately how much money does your company spend on research and development annually, such as wages, supplies, and contractors? Less than $25,000, more than $25,000 but less than $50,000, more than $50,000 but less than $100,000, or more than $100,000?
Well, it looks like we have a good mix in between the results here, where we have about approximately half of the company, or perhaps half of you responded to the survey under 25,000, whereas a good percentage have over 100,000. So hopefully you're taking advantage of the research and development credit. All right. Not that this applies to any of you or has applied to any of you when you were in your startup phase, but what happens with the startup losses that are generated in the beginning or inception of a company? And there's different treatment when it comes to how the losses are reported and captured in between a pass-through entity and a corporation. For pass-through entities, such as LLCs, LLPs, LPs, S corporations, it's important to consider whether the investor receiving their allocation of the pass-through income is passive or non-passive with respect to the company. And in order to be non-passive, there's a minimum hour requirement per year, so generally over 500 hours per year, or if you're acting in a management capacity in the business, you'll be deemed to be non-passive, and that's more beneficial because those losses that are generated in the company that are allocated to you can be used to offset other sources of income, such as wages, dividends, interest, and any other sources of income. However, if you're non-passive with respect to that activity or a particular investor is, those losses may only be used to offset other sources of passive activity income, and anything else gets carried forward into future years and may only offset future passive income. And even before those losses can be utilized, it's important that we as tax preparers or those of you who are invest in a company make sure you have tax basis in order to utilize those losses, and we see that in two ways. It's through contributions to the company or an equity capital contribution, or loaning the company money through recourse debt. On the flip side, when it comes to corporations, the tax treatment of losses is different. Since the corporation is a tax-paying entity, the losses are captured at the corporate level and are subject to certain carryback and carry forward provisions. So if you have a loss in a year and if you had taxable income in a prior, you can carry them back 2 years. Or if you have future taxable income, you can carry forward those NOLs to offset future taxable income for up to 20 years. Also want to point out that there's certain limitations that are imposed on net operating losses of a corporation when there's a change in control of ownership. And that's known as the Code Section 382 loss limitations. And the loss limitations come into play if there's a substantial change in ownership over 50% in a prior 36-month period from any date and change of control. You'd have to potentially look back to determine whether one of these ownership changes occurred. And unfortunately, since the losses are a function of the fair market value of the company at the time of ownership change and a function of the IRS's long-term interest rate, which is in July was a little over 2%, some of these losses can get severely limited. So there's also built-in gain considerations that need to be considered if a lot of times we see with technology companies where a partnership or other pass-through entity is formed where someone's contributing property and someone's contributing cash, where especially with flexible entity types such as LLCs, losses can be allocated in a manner that's not pro rata. And what I mean by that is if a company puts in cash or if someone puts in property and doesn't have basis, sometimes the operating agreement will call for those losses to get allocated to the person who contributed cash. So as John mentioned before, when it comes to LLCs and partnerships, it's imperative that you look at the operating agreement or that operating agreement is formed at the time the company is at the time of inception to avoid future misunderstandings. And last, when we're going to talk about some of the exit planning issues that we have, and first of all, it's when you come in and there's a valuation of the company, how do you want to structure the exit of the company? And there's two ways of accomplishing this. Just sell a company. There's either through an equity or stock sale or an asset sale. And sale of stock in a corporation is different from an asset sale, but first we're going to talk about the stock sale or equity sale. And it's different in that the buyer obtains the carryover basis of the of the target's tax attributes, meaning property or their NOLs and things of that nature. So you don't get a step up in basis when you acquire the stock of the company. And we're not going to go into it, but there is an election that can be made to treat it as an asset sale. But if you don't make that election, you get whatever tax basis the acquirer had or the target had in their various fixed assets, intangible assets, and losses. And it's also important that even though you are acquiring the equity of a partnership interest, sometimes, even though the holding period is over a year, there's these hot asset rules where if there's any unrealized receivables or inventory, it could potentially lead to ordinary income to the person who sold their share of and pass-through interest. There's also an asset sale structure that can be used to sell a company, and that requires an asset purchase agreement that stipulates the allocation of sales proceeds. And this is very important because it's a binding agreement between the buyer and seller, and usually you have to come to terms and agree because there is a form that gets filed by both the buyer and seller to match these the sales proceeds allocated into different asset classes. And it's important that you work with an accountant and a good tax accountant when it comes to these asset purchase agreements and negotiations, because they can have pretty dramatic tax consequences to either one or the other parties in terms of how much gain could potentially be ordinary income versus long-term capital gain. Next, we have tax-free reorganizations, and as opposed to the tax stock sales or asset sales that we just talked about, there's a way where you can acquire a particular company's stock without it being taxable. And that's if stock is used as the consideration of the acquirer in order to acquire the target without using cash or debt. If cash or debt is involved, that's what's called boot, and that is generally taxable to the extent that debt is forgiven or debt is exchanged or cash is received by the target. There's 4 conditions that must be met in order for the M&A or the merger to be tax-free. And the first is that there's got to be a continuity of ownership interest. So at least 50% or generally 50% of the consideration that the target receives as part of the transaction must be the stock of the person acquiring the business. Now, it can go as low as 40% under case law, but the IRS's position on advanced letter rulings has been traditionally 50%. There's also must be a continuity of the business, so the traditional trader business of the target must continue, or the target's assets must be used at least for a two-year requirement going forward in order for the transaction to be tax-free. And there's got to be a valid business purpose other than to avoid tax. And under the step transaction doctrine, the transaction can't be a part of a series of multiple transactions that, when in bits and pieces, potentially one of those transactions might have resulted in a taxable situation. And there's also the use of tax attributes. We just want to mention, we'll talk about it. We've already discussed the 382 limitations, but it's just an important reminder here that if it is a stock sale, to be wary of that. And as John mentioned earlier, I won't belabor the 1202 capital gain exclusion. And as he mentioned, for stock acquired after September 27th, 2010, and as part of the PATH Act, that is 100% exclusion percentage, and it is permanent moving forward in future years. And last, there's the Section 1244 stock losses. And Section 1244 stock is generally small issue stock in a C or an S corporation where there's a limitation on the amount of property that can be contributed upon inception of the corporation. It's got to be under $1 million in order for it to qualify as Section 1244 stock. And there's also a gross receipts test to get the special loss treatment. The gross receipts test is just merely that there's a 5-year look-back period before the date of sale that maintains that 50% or more of the gross proceeds from the company can't be from passive sources such as interest, dividends, royalties, and things of that nature. But if it is qualifies Section 1244 stock, the loss treatment is beneficial because up to $50,000 of the loss is treated as an ordinary trader business loss as opposed to a long-term capital loss, which is very beneficial because only up to $3,000 of long-term capital losses can be used on an annual basis. Just want to mention a quick planning consideration here. If you are an investor in a company that is 1244 stock and you're looking at a loss potentially in excess of $50,000 or $100,000 if you're married, You might want to split that stock sale in between multiple tax periods in order to utilize as much of the $50,000 annual limitation as ordinary losses as possible. And that's all I have.
Okay, we have one last polling question. What is one tax-related issue that keeps you up at night?
Some pretty funny responses. Some people sleep well and some people don't even think about tax at night. And it seems like there is a common denominator here, and that's sales tax and state and local tax issues. And I tend to see that a lot too, and it's a good way to get tripped up because you don't know what you don't know. But as a shameless plug, we do have a state and local tax department here at Hine, and feel free to reach out to either John or I, and we can put you in touch with somebody if you do have any questions.
Okay, and with that, we would now like to give our attendees a chance to ask questions. If you do have questions, please submit them via the chat box in the bottom left corner of your screen. If we don't get to your question during the webinar, our presenters will follow up with you via email. We already do have a couple of questions. The first one is, do you have to send a 1099 to an LLC?
Yes, and the answer to that is, I believe you do. I think the exception applies to corporations, and the LLC operates as an LLC. It's a different entity. So.
Yeah, and it's for the performance of services, right, John? It doesn't necessarily apply to if you buy tangible goods or supplies like that.
Right, that's correct.
It's just for services and rents and sources of income such as that.
Okay, and then we have another question. Says you might have mentioned this already, but what are the requirements for a business to be a qualified small business?
Well, the basic one is that you have to have not more than $50 million in assets at the time the stock is issued. So I think that's a pretty high bar. A lot of companies can reach that, and you have to be at least 80% of the time you have to be in an active trade or business. Can't be an investment vehicle. So those are the two big ones that I can think of. And then there's the holding period requirements.
And a C Corp.
Oh, and have to be a C Corp. Right. Good point. Have to be a C Corp.
Right. And for the individual who owns the stock, it just has to be the original issue stock. It can't be acquired from a third party.
Right.
Okay. Another question, what is the best entity structure for small startups that receive seed money from friends and family?
Well, I think LLCs in my mind are the best because they allow flow through of what typically is losses in the initial stages, and there's a lot more flexibility around LLCs than C Corps or S Corps.
Yeah, I agree. Especially with startup companies, you never know what the future is going to hold. So with S corporations, there's the requirement that owners have to be U.S. domestic individuals, whereas LLCs ownership can be a foreign person, a company. It's extremely flexible, as John mentioned, and also if you want to, there's certain parts of the economics of your relationship, and you want to allocate things in a certain manner. It affords a lot of flexibility to achieve whatever the objectives that you're looking for as a business owner.
Okay, it looks like that's all the questions that we have. If you do think of anything else, feel free to submit them, and they will get back to you. Thank you, John and Matt. That's all the time we have. Please check your inbox for a follow-up email and an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you again for attending.